Good morning, everyone. First of all, I would like to thank Follow the Money Group and especially Joanne, because Joanne Jobin has been helping out Jaguar in its investor relations campaign since 2015. And I know, Joanne, you got injured a couple of days ago, so we wish you full recovery soon. Exciting day for gold as compared to yesterday. I think we're doing way better than we were from a trend perspective today, and hopefully that trend of today is the future trend as well. As Brandon mentioned, I'm accompanied here by Jonathan Hill, or John Hill. John is our VP Exploration. So the way we're going to cover this presentation is I'm going to walk through almost the first half, talk about operations, talk about costs, talk about balance sheet, and then we will go into exploration as part of the second half, followed by a Q&A. So going into the slide number 2, the forward-looking statements. One of the things we are supposed to highlight as part of these presentations is we will be making some presentations as well as some statements which are future-looking. And they are speculative to a certain extent, and our shareholders should be aware of that. So that's just a statement out there. So Jaguar Mining has been a company that has been in existence for quite some time. So a lot of our shareholders are long shareholders, and they know the operations, they know the company. But I think as we may have some new shareholders or prospective shareholders joining in the future, I would like to give a bit of an overview in this presentation of what Jaguar is, where our assets are, and how the company has is really got a growth potential in future. So Jaguar Mining has got its assets in an area called Iron Quadrangle in the Minas Gerais state of Brazil. Minas Gerais, as you can probably guess, in Portuguese means mining, general mining. So this state is highly prospective in mining, iron mining, gold mining. Gold has been mined here for over 300 years, so it's not a new state. It very much resembles the Abitibi region in Quebec and Canada. Although it's lesser known, I think in the global stage, but it's almost equivalent, in terms of production of gold. Jaguar has 2 operating mines and 1 mine on care and maintenance. If we go back a little bit in the history, in 2016, one of our mines had an operational technical issue, and since then we had some declining production. We recapitalized the company in 2019, brought in a new CEO, Vernon Baker. Vernon Baker is an operator. If you have ever had a one-to-one conference with him the past 6 months, you'll find him. He's dressed up as just coming out of the mine. He's an operator. He's in Brazil, very hands-on. And most of our management team is in Brazil as well. So in part of this presentation, we'll be going through, our capital structure, our balance sheet as it is strengthened as compared to 4 or 5 years ago. We'll talk about our growth potential, and John is going to talk a lot more about that. And that's where we are very excited for in the future. So from a capital structure perspective, one of our largest shareholder is Eric Sprott. Eric joined as an investor in 2016. He then also participated in the next 2 private placements in 2017 and 2019. He owns a significant portion of the company. Sprott Asset Management is basically it's separate from Eric. It's independent. They bought Tocqueville Asset Management, which was our major shareholder, and that's how they are our almost second largest shareholders now. from a balance sheet perspective, I'm going to talk a bit more about in the later slides, but I think I want to highlight a couple of things. Our balance sheet is way stronger as it was a couple of years ago. We've got cash of $30 million. We are virtually debt-free. We've got almost $3 million of debt left, unsecured. In fact, in this quarter, we've paid down. In the third quarter, we paid on a little bit more. So hopefully by the end of this year, we can get rid of the debt and we would be entirely debt-free. We did announce an exciting news today morning for our shareholders, share consolidation followed by a dividend announcement as well. We think this is the right strategy. Jaguar has really gathered a momentum over the past 12 months in its stock price, as you can see in the graph. It's time to consolidate our shares, bring in some new institutional investors, as well as start paying some cash dividend to our shareholders if the gold price and FX continues in the same trend as we see right now. So let's talk a little bit about Iron Quadrangle and what unique position Jaguar has. So you see on the map here, Minas Gerais is the state, the mining state I was talking about. We've got both of our mines very close to major infrastructure. So Turmalina and Caeté are very close to the Belo Horizonte city, which is a large city. We are almost a couple of hours away on each side. So it has a very well-developed infrastructure, very well-trained labor force from a mining perspective and also in other areas as well. And once again, the governments, the authorities in this state are very well aware of mining activities. So it's a very well-supported mining area in Brazil. Jaguar currently owns 27,000 hectares in the Iron Quadrangle. We've got some land positions outside there as well, but I think our focus is this 27,000 hectares that we would like to grow in the future. We're also going to talk about a bit more about our potential for growth vis-a-vis our extra capacity in our plants, and I'm going to get to that in a few moments. But I think we have been operating in a very safe way. We also have a COVID-19 action plan that we put in place in late February. Because of that plan, we have been far less impacted because of this pandemic. As part of the plan, we suspended all travel between our sites and corporate and between the sites themselves as well. Cloth masks were made mandatory since the end of February, and temperature checks upon entering the mine are compulsory. So those things have really helped us keep our focus on operations and reduce the risk of the pandemic spreading at our mine. So let's talk about a bit more about growth opportunities and the catalyst. So, one of the things which John Hill will talk about is the growth potential, but what is really supportive of these growth potential targets that we have on our radar is the extra capacity in our mills. So Jaguar currently has Turmalina and Caeté Plant. Both of these plants are at almost 50% utilization. So when we talk about a new target, if we find 500,000 ounces in resources, for us to bring those new resources into production is not as difficult as it would be for somebody who has no infrastructure. Our plants have 50% more capacity. So by spending a little bit more money on some upgrades, we can really bring those new resources into production. So that gives us a really good edge in terms of a future growth potential, and I think that's one of the key highlights we need to focus on when we go ahead in increasing our production in future. Let's talk about a little bit about the growth story here. As I mentioned here, you can see Jaguar did have a good production in 2016, but we started to have some technical issues in Turmalina. At the background, you can see the stock price also had the same trend reflective, which we had seen in the production. 2020, Q1 2020 was the first quarter when we released our when we showed free cash flow. For the past 3 consecutive years, we were in negative free cash flow. So we had a marginal free cash flow in the first quarter and a significantly stronger free cash flow in the second quarter. If you just pick up the second quarter of free cash flow, you plug in the recent gold price, the recent FX, and you take in 24,000 ounces, you will see a result that is exceptionally sound and should show our strength in future production. So I think I'm going to also walk us through some of the turnaround steps, and these are the highlights which I really talk about when I talk to some of our old investors as well as some of our new investors. When I joined the company in 2015, 2016, we had almost $50 million in debt. We had negative free cash flow. The life of mine was limited to 2 to 3 years. Weak production, operational costs were pretty high, and the development of the ramp in our underground mine was not at a good rate. Where do we stand now? I apologize for the error here, but it should say debt is less than 3 million. It says more than 3 million, but so debt is right now less than $3 million. Treasury is 30 million. Free cash flow potential approximately going ahead around $15 to $20 million pre-tax. We'd be paying income taxes going in future. We just paid the second quarter income taxes in Q3. The life of mine of our assets has almost doubled since then. We've gone on the reserve side over to almost 5 to 6 years, and on the resource side almost 10 plus years. And I think one of the highlights is when we have gone through this downturn in production in the past 2 to 3 years, we have really tightened our belt on G&A and as well as operational costs. So our operational costs are significantly lower as compared to other operators in Brazil. And I think that gives us a really good leverage going ahead as well. With a clean balance sheet, with low operational cost, and an FX which is declining in the past 1 year, we are really positioned well for generating significantly strong free cash flow. Once again, I think I've touched this a little while ago, but we did show free cash flow in the first quarter of this year. What our commitment has been to our shareholders lately is that we have to produce every quarter higher than we did in the past quarter. So if you look at the 5 past consecutive quarters, we have consistently produced higher in each quarter. We are focused on continuing that trend going ahead, as well as one of the indicators on that trend is your development, underground development in the mines. So if you have to see anybody saying, if anybody says that they're well poised for future growth, you have to see their underground development, and that's one of the key factors. You can see on this screen that Jaguar has really invested a lot more in underground development in this year and the last half of last year. We'll see that that development at the rate of approximately 500 meters per site per month gives us the flexibility in the mine plan, gives us the flexibility. If something goes wrong, we have other options to tackle that problem and still continue to produce at a good rate. So I think that meters of development, along with our cost profile, should bring back a lot of confidence in the company going ahead. This was the operation results that we released in the second quarter. Once again, I would like to highlight a couple of things here. The tonnage has gone up, but I think the grade has significantly improved. That's one of the things we are really focusing on. And to make this a sustainable operation, a sustainable growth story going ahead, our focus is to have sustainable development every month. That's one of the key success factors. Our CEO and our entire operations team is really focused on getting that 400 to 500 meters of development per month per site. So that ensures that production rate in the future is also sustainable. And then you will see in the future also that our drilling is going to go up. John is going to talk about it. We've got new drill rigs working on our sites, and that should bring in some exciting drill results in the future. We did increase our reserves and resources, as I mentioned earlier, in the past 5 years. On the reserve side, the life of the assets has gone up from 2 to 3 years to almost 5 years. On the resource side, it has gone up almost more than 10 years. So I think that trend we think will continue. We're going to be putting out new reserves for Pilar, hopefully next week. That should be an exciting result as well. And that should continue the trend that we have been following, that you see in this graph as well, of increasing the life of our assets. Turmalina Gold Mine, as I mentioned earlier, was a mine which was a flagship in 2016. It had the underground issue. That issue has largely been fixed, but this mine historically was producing 50,000 ounces, dropped down to 33. Now it's going back up to 50. So hopefully, we're going to go back to that 50,000 ounces per quarter number soon. Pilar has been the biggest change in our operations, and it has really strengthened in grade because of some new ore bodies that we found at the bottom, and as well as overall, increase in tonnage as well. John is going to talk about some growth opportunities in and around Pilar, which should be very exciting in the future. So without further ado, I'm going to hand it over to John. I think I've taken a little bit more time, John, but take your time and walk us through the excitement that you see.
Thanks, Hashim. Thanks, everybody. Really we're in very exciting times now. Being able to build on the successes of our resource reserve build over the last 3 years has been probably a remarkable story, which underpins our ability now to focus on growth as opposed to getting to a point where we're sustainable. How have we done that? Well, I'll talk you through that. But essentially, while we haven't had much money over the last few years to spend on exploration, where we have had money, it's been well spent drilling, increasing the reserve resource base. And we've added those resources that Hashim mentioned at a very cheap rate, at less than $10 an ounce. In doing so, we were very careful about the placement of drill holes and the allocation of our focus. And we have maintained and kept a team of professionals active during that time. And as a result of that, we can now use that knowledge that they've built up in terms of understanding better the structural geology of the mines and then applying that to the near mine growth opportunities that we have now as a portfolio of exciting projects that are feeding now into the growth story at Jaguar. There's a lot of prioritized organic exploration opportunities that I'll quickly walk you through. The news flow will be starting from now on over the next few weeks after we release the reserve update for Pilar. Then we've mobilized our first rig during July. We have another rig mobilizing at the moment, and we've also purchased another 5 rigs for the company that will be in operation towards the end of the year. We have organic growth potential at both of our mines, inside and, as I mentioned, close to the mines, and I'll take you through that. And this is the ability of the mines to carefully control their grade, improve the performance in development, has now allowed us to really move the focus, as I said, onto our organic growth opportunities. The next slide. Just step back a little bit. We talked about the Iron Quadrangle as where we are. This is our focus. We're the second largest landholder after AngloGold Ashanti of the producers in the Iron Quad, with just under 30,000 hectares of prime real estate. This greenstone belt is equivalent to the, as Hashim mentioned, the Abitibi and the Yilgarn. It's the third most endowed greenstone belt of its nature in the world, but it hasn't seen anywhere near the amount of exploration as those two belts that I've mentioned for various reasons. Mainly that the ground has been largely held by 2 companies, Vale, who are iron miners and have sterilized to some extent some of the high priority gold areas, and AngloGold, who have focused on brownfields opportunities immediately around their operations. But having said that, the other remarkable fact of the Iron Quadrangle is the nature of the ore bodies. They are fairly small in terms of surface footprint, but extend to great depth. The best example of this I can highlight on the next slide here was the Moravello mine of AngloGold Ashanti, which closed down in early 2000. That went to a vertical depth of 3 kilometers, but down plunge up to 7 kilometers. So, and this is a consistent feature across a lot of occurrences, and applies very much to Jaguar, and why we have had the success that we've seen on our Turmalina and our Pilar operations. But there are many other occurrences that have a small surface reflection, but now with the opportunity to really understand the controls on these mineralized systems, one can, with great confidence, focus in and target depth extensions at high grade on these targets, and that's something that we're really leveraged to do, especially because we have excess plant capacity adjacent to all of our areas. Just honing in a little bit on the Turmalina mine. This mine has been mined probably for just over 10 to 15 years. Its deepest parts is about a kilometer down on the main ore body called ore body A. But in recent times, a secondary ore body called ore body C has been being explored and generating a large percentage of the remaining resources and reserves, even though high grades still persist at depth on ore body A. Having an extra ore body close to surface with a lower cost profile has really allowed us to stabilize the production on the mine. And in subsequent slides, I'll show you how the work that's been done by the geological teams on those mines in understanding the geological and structural controls has allowed us to really highlight high-grade areas within high-grade chutes within their overall structures, which we can now trace down with confidence and demonstrate a lot more potential to realize high grade in these operations. On that table, as well as a couple of other resource areas on the property at Turmalina, which have not seen have significant resources, but have not seen much technical work due to them being of a refractory nature based on prior work that dates back 30 years. So we're re-looking at these high-grade resources at the moment. We've got a drill rig operational there, and we'll re-look at the metallurgical test work and on the basis of improved technologies that exist now that weren't available back in the day, and that can automatically add up to 500,000 ounces of higher grade material that could leverage our excess capacity at that operation. I'll talk a little bit about that in a minute. Turmalina, in terms of our strategic planning, it's really, as I've said, we are focused on continuing to explore at depth on our primary ore body A, but with a renewed focus on ore body C, which is much closer to surface. And if you look at the graph in the center, you can see what we call an ounces per vertical meter profile. That's a very important measure for underground mining, as it dictates the amount of descent in terms of your underground development. All mines go down, and we need to use this measure to allow us to quantify what is the productive capacity of these ore bodies. So at Turmalina, you can see that it's close to the surface, where we include ore body C and ore body A, we can get up to 2,500 ounces per vertical meter in the profile. As we go down, where we have less information, we're only really seeing the ounces per vertical meter attributable to ore body A. So in terms of exploration potential, chasing down to depth ore body C automatically shows a greater ounce per vertical meter profile. And then if you want to convert that to production, you have to apply mining parameters for support and metallurgical recovery. So we're looking at this stage of aiming for 1,000 meters plus of recovered ounces per vertical meter once you've included mining recovery and metallurgical recoveries. So that sort of dictates the planning and the productive capacity that we see now on this operation. The other important thing at these types of operations is you do need to keep a greater than 3 years of reserves in front of you, just so that you can have flexibility in your mining plans. And as you can see, we've worked very hard, and we've delivered specifically at this operation over 6 years of reserves as we stand now at this mine, which is very remarkable given where we were only several years ago. What we do in terms of exploration targeting is we try to present on long sections, as you see here, a reflection of the grade over the width of the intersections of the pierce points of the drilling. And this is how we can visually and present to you, how high grades are elongated in the direction of the plunge going down to depth, and how we target these with our drilling programs. Once you have underground development, you can map, you can measure the plunges, you can be very predictive with your exploration, and we've been very successful with this strategy at Turmalina. And now we're targeting C Central, C Southeast, close to surface, and as you can see, getting quite remarkable intercepts. In terms of modeling of the ore bodies, C ore bodies have been historically seen as lower grade, and they've been modeled as such because the widths tend to be a little bit more than on ore body A. However, there is an opportunity for us to remodel these ore bodies and at a narrower widths and consequently get higher grades. And this will also allow us to maintain the flexibility of our grade profile going through the mill. Just another similar long section, just showing the distribution of our measured, indicated, and inferred resources, and the location of our drilling, which always aims at the very least on a given year to replace depletion. And with the excess plant capacity, we can focus in mine now on adding additional resources to leverage that extra capacity from inside the mines. But now also on the property itself, and this is really where the excitement is going to build at Turmalina and elsewhere, is that during the last couple of years, our teams, even though they haven't had any exploration budget to drill, they've worked very hard on basics and doing the basics right. And here we have an updated geological map of the Turmalina area. The circles on the map really show the bottom right-hand corner is where our current operations are, and the circles to the north of that are the finer and pontole areas where the refractory ore bodies have modest but very interesting high-grade resources already delineated. Another interesting target is Zona Basal, where we plan to be doing some drilling in the fourth quarter of this year. At that target, we've generated over 1.5 kilometers of plus 100 ppb gold in soils. We have coincident magnetic signatures similar to what we have at our mines at ore body A and C. And in addition to that, there's anomalous antimony and arsenic coincident with that. And we also have done trenching and demonstrated bedrock sources and a structural control on that surface expression of mineralization. So we have a number of other targets that are also going to be tested that have been generated from a high-resolution drone survey, which we recently completed in the area as well. Just moving back to the finer target. Finer has got 400,000 ounce inferred resource at about 7 grams per ton already delineated. We're targeting that at the moment with 4 PQ metallurgical holes to redo and review the metallurgical test work on that ore body. And we have high hopes of being able to at least leverage the milling and upfront plant to allow a production decision on this asset, and if possible, a flotation circuit, as well as then deciding whether we can justify an autoclave if it remains refractory, or sell a concentrate. Just moving to Pilar, very similar situation to what we see at Turmalina, in that our strategy has been to follow the high-grade plunge persistent shoots down to depth to add essentially life to those mines. But in recent times, we've also discovered laterally a whole series of other ore bodies that are within very close access to our ramp infrastructure. The drilling that we've been doing over the last 12 months in these areas is adding resource to the inventory and demonstrating opportunities for increasing productivity in the shallower areas of the mine as well. So there's a double impact. We chasing plunge persistent shoots to depth to add life to the operations, and adding incremental ounces per vertical meter, as I mentioned earlier, laterally to add productivity to the operation. And as Hashim mentioned, next week we are going to be presenting an updated resource and reserve for this particular operation. Now, this is just another more simplified slide, just to show you once again that we have, in terms of resources, a very impressive more than 2,000 ounces per vertical meter potential at Pilar, of which we aim to recover 1,000 ounces per vertical meter with the mining and metallurgical recoveries included. But certainly the other opportunities that are presenting themselves at Pilar are remarkable, and there'll be news flow over the coming months on that particular project. In addition to that, a surface rig is going to Pilar to follow the host structure from surface along strike. We've identified a further 3 kilometers strike length with trenching and with some sampling of prospective shallow mineralization that will also help us augment the resource base at that operation and the opportunities that we can derive through our excess plant capacity there. As I said, these intercepts are from last year's infill drilling, and we've been drilling more focused since early this year with an underground rig. And these intercepts will inform the reserves that we present next week and the resource upgrade. The intercepts that are highlighted here are those that are greater than 25 gram meters. Just handing back to Hashim now, but before I do that, really in a nutshell, Jaguar now has an opportunity to leverage its excess plant capacity with a whole portfolio of very high quality targets within their land package in the Iron Quad, and we have a very aggressive plans going forward from right now. We have an extra $5 million to spend before the end of the year on these programs, and we look forward to presenting news flow and results from those exciting opportunities over the coming months. But I'll hand over to Hashim now to wrap up.
Thanks, John. As we wrap up, I'm just gonna cover off these points, which I think we've mentioned in the presentation. But our commitment to our shareholders is to go back to the 25,000 ounces per quarter production for our two assets combined together, which should take us to 100,000 ounce production with a low cost base. Today's gold price and the FX, that demonstrates a very significant free cash flow that the company is going to generate in the future. There is no debt obligation which is onerous on our balance sheet anymore. And the life of our assets, both of them have doubled in the past 3 to 4 years, and we hope that trajectory should continue in the future as well. We are actually quite optimistic that trend should probably again happen in less than 2 to 3 years, probably earlier than that. And the excess capacity in our plants. So if John and his team are able to find new resources for us to bring those into production, the capital spend, the approvals, the permits, everything is way easier for us because we have got an existing infrastructure to do that. So with that, I am going to wrap up, and I believe we're going to ask Brandon to see if there's any Q&A.
Absolutely. Gentlemen, I appreciate the time you've taken to go through that. Lots of information in there, very technical. I know many investors who are looking for that side of things, they don't get that as often. So I appreciate that a lot. And there are some questions that have come in here, so we're going to jump right into them. The first question here, and then between the two of you, can always decide who would like to answer the question. The first one is Jaguar evaluating any potential M&A opportunities?
Yeah, I think a valid question. We've been presented with M&A opportunities in the past 3 to 6 months, and the entire M&A sector has got quite heated up. But I think one of the things which our board and management is extremely cautious about is we don't do an M&A just for the sake of an M&A. It has to really bring in strong M&A synergies, not only on the G&A side, but also on the operational cost side. The second thing I would like to highlight throughout this presentation, which I mentioned as well, was when you've got a 27,000 hectare land position, which is highly prospective on finding new resources, when you've got two plants which are at 50% capacity, and you can spend less than $50 million and double your production, taking that internal rate of return on any other $50 million acquisition it's not easy to beat in terms of time and return both. So we've got so much opportunity just right next to our current infrastructure that for us to find an M&A that's attractive enough to beat that is something we're looking for, but we haven't found yet. That being said, we are open for M&A within Brazil, which makes a lot more sense for us.
Absolutely, and well put. Appreciate that. The next question is here. Are you expecting the dividend that was announced today to be sustainable / consistent quarter over quarter going forward?
Yeah, no, that's a brilliant question. I was thinking about this today morning as well, that somebody should ask me that. So a couple of thoughts there. I think if you look at the cash flow of the company 3 to 4 years ago, you will see that we were almost servicing debt at the rate of $4 to $5 million per quarter. Now we don't have debt. So isn't it nice to pay that same money back to our shareholders? I think yes. So instead of paying debt holders, should we be paying shareholders? We will be looking at that every quarter. We haven't. That's why we have not declared this as a special dividend. If the gold price, the FX, the production, all continues to be in the same range as we have and grow even further, I think expecting a quarterly dividend is quite likely.
Very nice. I'm sure many investors would like to hear that from you, so I appreciate that. The next question here is, do you expect to keep building a treasury position? Staying really on the financial side here for a moment.
Yeah, I think balance sheet wise, as I said earlier, we've got less than 3 million debt left. Our plan is to pay that debt off this year. So once that's gone, let's pick up our quarterly free cash flow after that. If you're generating $15 million hypothetically in free cash flow post-tax, even after increasing the spend that John Hill just talked about on exploration, even after spending a little bit more on sustaining capital to get some new equipment to increase productivity, I think our capex on a quarterly basis should go up from its current run rate by a maximum a factor of $5 million per quarter. So 5 million goes there out of 15. 5 million, hopefully we can return back to our shareholders as dividend. And then the balance we add to our treasury. I think considering where our treasury is right now and considering we do not have any financial obligations that are onerous for us, we have enough cushion built in there. So if there is an incident shutdown because of a pandemic or anything of that kind, we should be able to take that more comfortably. We do not want to add treasury, of course, and not invest that. So we think either it should go into growth programs or it should go into an acquisition of a resource, which could happen. As John mentioned, IAMGOLD and Anglo have significant land positions around there. If there's a resource we can buy, that would be a good investment. But if not, dividend should be paid to the shareholders, and 1/3 should be probably added back to the treasury to marginally make it more comfortable for future.
Absolutely. We're sticking on the financial side once again here. Now that free cash flow has improved, are you expecting any increases in capex spending that was perhaps put off in previous years where cash flow was insufficient to support it?
Yes. So I think if you look at our past, our average capex was around $6 million per quarter, sustaining capital. We are probably going to up that by a factor of $4 to $5 million every quarter. And as I said earlier, significant portion of that should go to what John Hill and his team is doing in growth exploration. So it's not going to be really sustaining, it's growth capital. It's non-sustaining. But I think we're going to be spending there. In Q3 and Q4, we also expect to spend, probably a couple of $1 million more per quarter in sustaining capital as well. At our mines, we are installing a dry stack filter press system, which should give us more capacity to dry stack our tailings and increase the life of our assets from a tailings perspective. So that investment is much needed and will help in sustaining the growth. So we are spending there. We do not have any other major spend. We would probably spend, maybe a couple of $1 million every 2 months on getting some new equipment. But there's not a big long list of high capex items apart from the filter press system that we are installing.
Absolutely. The next question is from Tom. It's saying, what is the impact of the BRL devaluation on the costs, and what is the forecast for 2020 and 2021?
So great question. I'm gonna round it up in 2 points. So if you have to take on the BRL impact on our production, the easiest way, because we've run sensitivities various ways. So the best way is every 10-cent move in the BRL. So let's say it goes from 5 to 5.10. Every devaluation or appreciation, either way, a 10-cent has an impact of around $20 to $25 per ounce on our cash flow. So if BRL goes, which it has, from 5 to 5.5, it's added 50 cents. That's an impact equivalent to having $100 per ounce added cash flow for the company. So that could give you a bit of a perspective there. Where do I see the forecast? The thing is, forecasting currency is actually slightly better than forecasting weather, because you have a better chance of predicting it. But I think we should be able to see the BRL comfortably between a range of 5 and 6. That's the range which everybody is predicting it. If you pick up the BRL where it was in 2015, you apply the inflation rate in the country, you will see that the currently where the BRL is a very valid and comfortable region for that. And the best thing around this devaluation is that there is no inflationary pressure in the country. The inflation has been very calm and cool at 2 or 3%. So that means that there's no internal cost pressure on the company as well. So we should be able to, and we are entirely unhedged on the currency as well as the gold. So we should be able to take benefit of this.
Fantastic. This next question comes from Miko. They are asking, how much skin in the game does management have, and how are interests aligned with shareholders? Very good question there.
Yeah, very powerful question. Management has a couple of things. We have, if you look at the past history of the company, we've had some changes in the CEO, but Warren Baker joined us in Q3 last year. Warren has stock options which are linked to the performance of the company, of course. So that's a very strong link there. But I think the other thing is, despite where the gold price goes, our management has kept our basic compensation still the same as it was a few years ago. Most of our payback is linked with stock options and equity. So if the equity does well, the shareholders do well, the management does well. So we are quite linked to that, and our compensation plans are also reflective of that.
Yeah, and personally, as an investor myself, I like to hear that, because that those interests are aligned, because it benefits both parties if you're getting share price appreciation. And the way to get that is by performing. So I like to hear that. Another question here is from Bobby. Is the company considering a buyback, or is it just the dividends at this time?
So we did initiate a buyback a couple of months ago. We started buying back. We got the approval from TSX. And, as soon as we started buying back, for the right reasons, the stock also started going up. We have currently suspended that program because, instead of doing the buyback, we are paying the dividends right now. We are spending the money on that. But I think in the future, that plan is already approved by TSX. We can bring it back whenever we want to. It's an approved plan for the next 1 year. So we're looking at, what's the right point. We look at our earnings. We look at where the share price is. We'll see the post-consolidation performance of the share. And then we'll decide, based on if we feel that the market is really not appreciating, or there's a lot of undervaluation, then we'll go ahead with the buyback again. But we have the approval there, and we did use it in the second quarter slightly.
Beautiful. So it's in the arsenal of what you can use at any given time, should you decide that's the best course of action.
Exactly.
This next question. Oh, there is one more actually. Or I'm assuming this will be our second last question. Is from Tom, and he asks, "Do you think you will reach stable production by the end of 2020?"
I think once again, I'm going to highlight what I was mentioning in one of the slides as well. One of the indicators of stable production is the ramp development meters per month, that KPI. If you see that KPI in Q1, Q2, it has been gradually building up. And based on that, we have we have a good high level of confidence, I would say, that we should be going towards 24 to 25,000 ounces production per quarter. First half of the year, we were ramping up on development. Now we're getting into Q3 and Q4, where not only we will continue that underground development rate, but also we will build on our capacity in terms of improving the grade. The dilution is under control. So a lot of those factors are going to feed in, and I think we should be seeing that 25,000 ounce production every quarter going ahead.
Beautiful. And this will be it might not every time I try to say it's the last question, another one pops in, so I like that though. But I feel bad, John. You must have just absolutely destroyed your part, because everyone understands the geology. They understand all that aspect. There's a lot of it is on the financial side. But that's why we have both of you on here for your specialties in this. But this next question, once again, is on that same wavelength that we've been going on. This is from a different Tom Wharton, asking, discuss the rationale of the 10-for-1 share consolidation and how that will enhance shareholder value.
So we looked at various combination ratios, and if you go back and look at the company back in 2014, it had approximately 100 million shares. I remember 111 million shares. So since the issue we had in 2017-18 and the subsequent private placement we did, there was significant dilution. But we want to kind of take it back. We wanted to kind of take it back to that same number, 100 million shares. So we were looking at approximately that. We are around that number, around 70 million, 73 million approximately. And I think that's a good number. But I think the key thing here is also the rationale behind the share consolidation is that we would like some new institutional investors to come in as well. We've got a lot of feedback from some of our shareholders and also some prospective shareholders that you should consolidate, because especially the investors in the US sometimes are prevented from investing in companies which are so-called penny stocks. So consolidation enables them to come back and be part of a $1+ stock, which in this case is going to be more than $1, but that enables them, and I think that brings in a lot more interest in the stock as well.
Absolutely. Now, we are going to cap the questions in there, because we are at that point now where the next webinar is about to begin in just a few short minutes. For anybody who would be able to reach out to you, if they do have more questions, where would you like them reaching out to? How can they get a hold of your company?
Yes. So I think the slide that everybody can see, it has my email address. So anybody can reach us by that, or they can also reach our CEO by that email address as well.
Absolutely. Well, gentlemen, thank you very much for this presentation. I appreciate it very much there. For all of our attendees, we will be moving on to our next webinar very shortly. There is a very few short minutes to get up and walk around before our next presentation. But Hashim and John, thank you very much for this. I appreciate the time you've taken.
Thank you so much.
Thanks everybody. Sure.